With Whitecap Resources, you get a great monthly dividend, but are they ready for some serious growth in 2024? Fasten your seatbelts, folks. This is going to be a good one. Whitecap Resources is a Canadian oil and gas company that has been in operation since, well, back in 2009. They are based out of Calgary with a primary focus on acquisition, development, and production of petroleum and natural gas. They have become quite a presence in the energy sector, and that's not by chance. Their growth has included various strategic acquisitions, and they have followed a path of efficient operations while also balancing profitability with environmental responsibility. They have also included within their strategies a commitment to shareholder returns, which is underscored by a steady dividend policy and an overall focus on long-term value creation. In other words, they are striving to be a good total return option that is a wee bit heavier on the passive income side. These, of course, are words investors love to hear. Join the conversation. Let us know in the comments if you hold any WCP in your portfolio. Your participation is, of course, well appreciated. Don't forget to like and subscribe to stay up to date on future content. And a huge thank you for that click. Looking at Whitecap Resources and their overall strategy for growth and shareholder returns, it is very easy to see this as a potential great option for your investment portfolio. However, I certainly don't want to be accused of judging this book by its cover, so that means we are going to need the help of a dear old friend. No, we're not talking about Santa Claus, we're talking about the iconic Mr. Math. As usual, we will begin this fundamental journey by checking out the surface data. Their current value at time of recording was $9.15. They have a market cap of $5.55 billion. Their beta quite volatile, more than twice as volatile as the market average at 2.66. Their earnings per share come in at 1.50, and they have a price to earnings ratio of 6. The average amongst their peers comes in at 14.2, so that's not too shabby. Looking at some of those peers, we have Plus with a very low PE ratio of 4.7, Crescent Point Energy much higher at 20.8, and Prairie Sky Royalty at the top of the heap with a PE of 25.1. So WCP is nice and near to the bottom, and that sure does indicate that they may be undervalued. Their price to book ratio comes in at a cool 1, and the average in that peer group is 1.7. Their return on equity, that comes in at 17.79%. The surface data looks great and consistent towards what we have been expecting coming into this deep dive. So let's peel back another layer and get a good old gander at their cash situation. Their revenue, that comes in at $3.41 billion, and their earnings come in at $909.3 million. Those earnings are projected to grow by 17.79% per year over the next 5 years. That's absolutely awesome. I like that projection a lot, as that really will help improve these fundamentals in 2024. They have a profit margin of 26.7%. Now here's where we do have one concern. This is down from 43.9% just a year ago. Now, keep in mind, the energy sector did struggle in 2023, and this may be more of a sector issue opposed to a WCP one. Looking at their free cash flow, that comes in at $895.2 million, and their operating cash flow is a nice looking $1.82 billion. Let's take a look at their fair value. So their current value is $9.15. Using a discounted cash flow model, we do get a fair value of $12.64. That means they're undervalued by 27.6%. There we go. Undervalued is confirmed. And the 1-year target on this stock by analysts comes in at $14.10. So that's a movement of 54.1% in 2024. That's not too shabby. This is a nice target for sure, and if the analysts are correct, this could be very good for the stock. The cash situation is not bad at all, and I'm suspecting we are going to only see more improvements in the stock as we move forward. I will be very interested to see their next earnings that is going to drop closer to the end of this year, so we're only missing it by a few days. So let's move on and dive a little deeper into their actual returns. When it comes to their dividend, their yield comes in at a nice looking 7.974%. That is a monthly dividend paid out in the amount of 6.1 cents per share. And get this, the payout ratio is only 36.32%. This is a very sustainable dividend. And honestly, it's more sustainable than you usually see with a yield this high. I do like that quite a bit. Switching to their returns, on the 3-year, their price rose from $4 up to $9.19. That is a return on investment of 129.75%. Factoring in the dividends, we get a total return of 157.63%. Holy banana bread, that's pretty good. Now, we're only going to look at the 1 year because the year to date and the 1 year are pretty much the same at this point. Their 1 year did fall from $10.01 to $9.19. So that is a return on investment of negative 8.19%. And even the dividend couldn't completely save them. They still have a total return coming in at negative 2.05%. The 1 year is a wee bit disappointing. But once again, I think it is more of a sector trend than a white cap issue, and I am going to take it with a grain of salt. Regarding returns, I'm overall okay. They have a great sustainable dividend, and the 3-year ROI certainly shows what they can do. I am definitely expecting better numbers in 2024. So let's turn the page to our final chapter of this fundamental story and check out the debt situation. So their total debt, it comes in at $1.18 billion, and their total equity, that comes in at $5.38 billion, meaning we get a debt to equity ratio of 21.9%. This is stellar. I love these numbers. Just to rub in how good they are, this is a debt to equity ratio that has dropped over the last 5 years from 37.7% to 21.9%. In regards to cash and cash equivalents, they do have $60.4 million for that as well. Looking at the short term, their assets come in at $524 million and their liabilities come in at $718 million. Not perfect. As you guys know, I like to see assets higher than liabilities. However, these are smaller numbers, so not really a huge concern. When we switch over to long term, we get assets of $8.68 billion and liabilities in a better place at $3.11 billion. The long term is looking a lot better for sure. I do like their debt situation. The debt is easily covered by their operating cash flow, and the interest on that debt is well covered by that EBIT thing, earnings before interest and taxes. Okay, without any further ado, we do need to ask, what is the final verdict? I like this stock. It is a solid energy performer, and it does look to be a very good total return stock, and it's also not a bad passive income play. They have a good cash flow, and the efficiency of how they are using it shows up clearly in their payout ratio on that very sustainable dividend. Their debt situation also lends a lot of evidence to this overall efficiency. The only real downside is their 2023 performance, and as I said earlier, a lot of that can be chalked up to the sector woes of the past year. For a short-term investor, you have the passive income, and you may begin to see some growth sooner than later. So you do have time to sit on this one longer if you really need to. For mid and long-term plays, this is a solid choice, and we will more than likely see some impressive returns over the next year and beyond. As usual, if you are interested in this stock today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Keep the learning going. Watch my video on REITs, linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.